Hey everyone, my name is Drew Mahalik and this is my Stocktrak simulation project. To start with, this slide just lays out the basic structure of the simulation. We each began with a virtual $1 million portfolio and had 11 weeks to manage it. The rules required us to make consistent trades every week while keeping every position between 2 and 25% of our total account value. The purpose of the assignment wasn't just to make money, but to show that we could follow guidelines, stay disciplined, and maintain an organized portfolio throughout the entire trading period. In the beginning, my strategy focused on building a strong and stable base so I wasn't making reckless trades right away. I started with large cap companies like Nvidia, Microsoft, Qualcomm, and JP Morgan because those stocks tend to move more predictably and give you a good foundation. After that, I added exposure to energy and consumer names like Transocean, ConocoPhillips, Five Below, and H&I to spread risk across different industries. Some picks came from people I trust, but I still researched each one before buying. During the middle of the simulation, I made a lot of changes based on how the market was moving and how my positions were reacting. By that time, I had made enough trades to know which sectors were getting stronger and which ones were starting to lose strength. I added SOXL to my portfolio to try to take that advantage of the semiconductor momentum. Tech was heating up, and I wanted to be a part of that. After that, I switched to mutual funds like VFIAX and FXAIX to get more exposure, balance out the high risk moves I had made earlier, and meet some of the class requirements. I also added bonds because the market was getting more volatile, and I wanted something in the portfolio that wouldn't change as much from day to day. Another important thing that I did was cover my short positions. When the market started to stabilize, the hedge wasn't helping me anymore, so it made more sense to close them out and lock in my gains. Lastly, I kept changing how much cash I had during this time so I could stay flexible. I didn't want to keep too much because of the cash penalty, but I also wanted to be ready if a better chance came along. Those changes I made in the middle of the simulation really helped me get used to a more organized way of doing things instead of acting too quickly. Here are my results over the entire simulation. My portfolio gained 11.26% total, which is a big difference compared to the S&P 500's gain of about 4.3% during the same period. I ended the simulation with $1,112,552.89, and I made 75 trades along the way. My Sharpe ratio was around 2.54, meaning returns were strong relative to the risk. And the beta of 0.70 shows I was less volatile than the overall market. If you look at the chart on this slide, you can see how my portfolio value steadily climbed and how it stayed above the S&P benchmark line throughout the semester. Rig and Hive drove a chunk of that climb, while positions like SOXL and NLR dipped toward the end. This slide focuses on the behavioral side of my trading. In the beginning, I was honestly nervous with almost every trade, especially because I kept thinking I would run out of money before finishing all of the assignment requirements. That fear made me double check everything, which fits the classic loss aversion bias. After Rig and Hive took off, I definitely felt a boost of confidence and started believing I could time everything perfectly, which wasn't true. I also noticed some herding behavior. I listened to friends talking about tech and crypto, and sometimes that influenced what caught my attention. I still researched before buying, but the crowd energy definitely pushed me towards certain trades. Looking back, staying patient and sticking to my plan and understanding these biases helped me make way better decisions as the project went on. In short, this simulation taught me a lot about timing, being patient, and why it's important to have a plan before you trade. As the weeks went by, I got better at reading market trends and figuring out what really caused some of the bigger moves. I also learned that selling early isn't always a bad thing. A few times when the market swung hard, I was able to lock in profits at the right time. Another important lesson was how to be disciplined. I learned to take a step back and not let stress or excitement make me make rash choices like I did at first. I opened my own real brokerage account and I bought IBM with a long-term goal after the project was over. That alone shows how much I've changed my mind. I used to want to make quick money, but now I'm more interested in steady growth and consistency over the long term. This whole thing helped me decide how I want to invest in the future.